I've got either good news or bad news, and this is going to depend on where you are at with your credit, what the overall health of your credit profile and credit score is looking like right now. You see, there's some new FICO score changes that are coming. They're actually here. They're getting ready to be implemented, and these are changes that could affect your ability to get credit cards, a future mortgage loan, or any other major trade line, especially if you have negative items on your credit reports. So you're definitely going to want to hear this. But first, subscribe to my channel for credit updates. And if you do find this video to be helpful, please like it. It helps to get this video out there so others can hear the same. The newest scoring model is called FICO 10, and it is scheduled for release this summer. And it could result in credit score drops of 20, 40, 60 points or more. This could happen for more than 40 million Americans, as this FICO 10 model takes into account past debts and balances. So the FICO Scores developer, Fair Isaac Corp, has introduced the FICO 10, and then there's also the FICO 10T. These are the latest credit scoring models. So depending on where you're at with your credit, you might experience an increase if your credit score is good, but you might experience a decline if your credit is poor. So what's the difference between the two? Well, FICO Score 10T is different from FICO 10 in that the T stands for trended data. That uses information from your previous 24 months. FICO is checking to see if you've been paying off your debts or if you've been accumulating more debt. And they're going to give more weight to your credit card debt utilization ratio. They want to know what is the proportion of your available credit line versus your credit card limit. So in comparison to earlier scoring models, these new ones are going to reward those of you who have low or no credit card balances, but it's going to penalize those of you who have high credit card balances. It's yet another reason why you want to pay down or off credit card debt. This model is going to look at your credit card debts over the last 24 months to see if you've been paying off the full balance each month or if you are carrying a balance from month to month. And if so, how much? If you have a personal loan, that's going to be given a separate classification for the very first time by FICO, which gives them more weight. The fastest growing debt category in the United States with over 305 billion in outstanding balances is personal loans, and this is according to a 2019 Experian study. So what is the goal of the new scoring models? Well, it's to distinguish between borrowers who are strategically using loans like debt consolidation loans to pay off other debts versus those who are simply starting to accrue more credit card debt as a result of consolidating their debt into a personal loan. Finally, FICO 10 gives past late payments more weight. You can anticipate further score declines if you consistently miss those monthly bill payment deadlines. Different lenders use different scoring models. Different industries tend to use specific scoring models based on the most relevant data for them. So, for example, most auto lenders use the FICO 8 auto model. Most credit cards use the FICO 8 bank card model. FICO released both of these as part of the FICO 8 generation back in 2019. And so FICO 8 remains the most commonly used scoring model. Now let's talk about mortgage lenders. With FICO score 10 on the horizon, mortgage lenders are still currently using far older scoring models. Conventional mortgage lenders will pull a FICO score 2 from Experian, a FICO score 4 from TransUnion, and a FICO score 5 from Equifax when you apply for mortgage approval. And of these three scoring models, they use the middle score, or they'll use the lower score if only two of the credit bureaus return a credit score. They access a wide range of data by utilizing various scoring models from the various credit bureaus. Each bureau's report frequently misses information that maybe the other bureaus catch because not all creditors submit reports to all three credit bureaus. In its scoring models, Fair Isaac merely wants to maximize predictive accuracy. So more applicants will be approved, increasing the likelihood that lenders will be able to price their loans more affordably or more expensively, depending on how well the predictive accuracy performs. So here's how you improve your credit score. Despite all of these different credit scoring models, don't be intimidated by them. These models essentially reward timely payments, low debt to income ratios, a mix of credit, and the absence of negative marks like foreclosures, bankruptcies, judgments, and collection accounts. Follow these steps if you want to raise your credit scores. Check your credit and fix any errors. Pull your credit report and carefully review it for errors. I recommend getting your credit reports and your FICO scores over at myfico.com. FICO scores are what majority of the lenders are pulling. You can also get your credit reports for free over at annualcreditreport.com, although they won't contain your credit scores. And if you see anything out of place, fix it. Consider signing up for a credit monitoring service. MyFICO.com has credit monitoring. A lot of you love Credit Karma. These let you keep an eye on your credit score in real time, and they notify you of any sharp drops or any suspected identity theft. Pay every bill on time. Your credit score is ruined by late payments, so stop being late on them. If you have trouble paying all of your bills on time each month, your budget's not working. Delete that existing budget and start over with a new one. It is so critical to always make on time payments because your payment history accounts for the majority of your credit score. To guarantee on time payments, set up auto pay or reminders. Pay every bill on time. Your credit score can be ruined by late payments, so stop being late on them. If you have trouble paying your bills on time each month, your budget probably isn't working. So I would suggest deleting your existing budget and starting with a new one. And if you don't have a budget, I recommend putting one together. It's so crucial to always make on time payments because your payment history accounts for the majority of your credit score. And if you want to guarantee on time payments, set up auto pay or reminders. Pay down your credit card and unsecured debt balances. So while you should always make at least your minimum payments, I recommend paying your bill in full every month. This will reduce your utilization rate. And your utilization rate is your total credit card balance divided by your total available credit. The general rule of thumb is to have below 30% utilization on each credit card. Below 10% is even better. The lower your utilization, the better your credit score is going to be. So with this new FICO Score 10 model, it penalizes credit card balances. It rewards consumers who pay their cards down or off each month. Don't open too many accounts at once. An inquiry gets recorded on your credit report every time you apply for credit, whether it be a credit card or a loan, and regardless of whether you get approved or denied. Your credit score will drop by a few points as a result, and within a few months it should recover, but limit your applications as much as possible. There are some credit card companies, some lenders who they don't want to see more than 2 to 4 hard inquiries within a 6 or 10 month period. Use pre-qualification tools to shop around without damaging your credit. Try weekly payments to keep your credit utilization ratio low. Consider setting up automated weekly payments if you frequently accrue large balances and pay them off in full each month. It maintains a low credit utilization ratio so that your prospective lender will always see a healthy credit score and profile, regardless of when they run your credit. Keep old credit cards open. The average age of your accounts is a factor that FICO considers when it determines your score. The older, the better. So if you don't plan to use old credit cards anymore, keep them open. And if you have to, cut them in half, but keep the accounts open. If you need to build more credit, open up secured accounts. So if you haven't yet established much credit history or you're in the process of rebuilding credit history and your credit score is low, you can get a couple of credit cards. Check with your bank and check with your credit union. I recommend checking with these two types of institutions first. If you can't get approved for a unsecured credit card, you most likely will be able to get a secured credit card because they don't use your credit score. They don't do a credit check. One such type is called Self. It is a credit builder account. So rather than borrowing money from a lender, you are simply agreeing to make payments to Self as if it were a loan. And then they put those payments aside for you in an escrow account. And at the end of the loan term, you're going to get all or most of your money back from them. Here's a pretty interesting statistic. According to the Federal Reserve, household debt rose by $92 billion in the first quarter of 2021 to a record $14 trillion. It follows that FICO intends to penalize high unsecured debts more severely in its new scoring model. So, whichever scoring model an industry uses, your credit score, your credit profile has a significant impact on your daily life. It can mean the difference between you making a down payment of 3% versus 20% on your next home purchase, or of an interest rate of 3.3% versus 5.3% on that mortgage. So, restore your credit by sticking with the basics. Pay your credit card balances in full each month. Pay down your unsecured debt and pay your bills on time every month. In addition, stay away from negative marks like collections, judgments, and liens. If you do this, then you're going to have nothing to fear from this or any future credit scoring changes.